Welcome to Market Movers. I'm Jim Urio with Scott Martin.
Hi, Jim.
So, Scott, global growth has been called into question as we're starting to see the effects of the coronavirus being discovered as we go. Now, do you think the response is going to be that global central banks are going to throw money at it?
Yeah, and they're going to throw a lot of it, Jim, because it seems to me like, just reading between the lines from our Fed and certainly other central banks around the world, they want to overstimulate the economies if there is effect from the coronavirus versus understimulation.
It definitely seems that way. I agree with you. Now, if money's being thrown globally, does it automatically, at least a portion of it, flow to the U.S. because it seems like we're a little more insulated?
It does, but I think, Jim, there may be so much central bank money flowing around the world, it may go everywhere. I mean, we're starting to see negative interest rates pop up in Europe, all over the place, all over again, so therefore it may not just be a U.S. story.
Got it. Before we dive into our trade discussion, I'd like to point out that these are examples, not trade recommendations or advice. We're going to talk about two global assets. We're going to talk about crude oil, we're going to talk about the U.S. 10-year. Scott.
Yeah, global assets is a good way to put it, Jim,
right.
as ways that I believe the virus and certainly central bank intervention is affecting different asset classes. So there's some neat things to look at, I think, across kind of the arena to see how that's being taken. So specifically, Jim, looking at buying the week one crude oil 54.55 call spread for 4 ticks. This trade expires on March 6th, so a couple more weeks of news to get through here. It risks 400 to make potential 600. The underlying, by the way, was 53.25 when I priced this out. Here's the thing. If you look at the chart on crude, it's pretty simple. Drop from 65 to 50 is bounced since. It could retrace, say, about 50% of that move up to 57. There's a 50-day moving average up there. And I believe with all the central bank stimulation that's going on around the world, it's likely we're going to get a boost in risk assets and therefore crude.
I like it a lot. The move down from 65 to 50 was demand destruction because of the potential economic effects. And at 50, there was talk of OPEC talking about production cuts to boost the price. I think 50 was the line in the sand.
Responded.
Yeah. I'm looking at the 10-year, and as an example here, like this to me is a way, an idea to hedge risk in case things go worse and more central bank money comes. I'm looking at buying the week 1 March 131.5, 132 call spread in the 10-year for 8 ticks. It also expires March 6th. It risks 125 to make a potential 375. When I priced it out, the March was trading 131.04, so 12 ticks below the bottom strike. Again, this is all the central banks throw money at the problem. A portion of that ends up in the U.S., drives yields down. Do you like it?
Yeah, and I think there's another outcome too that's potentially factored in here is the fact that, let's just say, economic data continues to be negatively influenced from the coronavirus, and or, like you mentioned, central banks overstimulate and really step up the liquidity efforts. Rates are dropping.
And the one thing, when Powell, we heard from him, he sounded rather sanguine. He didn't sound like he was that worried about things. The market doesn't really believe him. They believe he'll pull the lever at the time comes.
They do, and I think it's because Powell has proven himself in the last, say, 12 to 18 months, Jim, that he's got his eye on the right things.
No doubt. Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.